Mortgage Dr. Rich here with part two of a two-part production on debt-to-income ratios. In a previous video, I discussed the front end or housing expense ratio. Well, we're not going to be able to determine a borrower's ability to repay simply by looking at their housing expense. What happens if their housing expense was very low in relation to the cost of owning the home, but they had a ton of additional debts? So we're only going to be able to analyze their capacity by looking at a second debt to income ratio along with the housing expense ratio. And the second debt to income ratio is the total or back end debt to income ratio. So the total or back end debt to income ratio looks at the complete housing expense that we calculated for debt to income ratio 1 plus consumer debt, which constitutes the monthly minimum payments, the sum total of all monthly minimum payments owed on credit cards, loans, and leases. And we typically get that from the credit report, plus long-term debt. Long-term debt refers to any other financial obligation to which the applicant is obligated that doesn't appear on their credit profile. So we're talking about things such as alimony, obligatory alimony, child support, separate maintenance. Let's say you're reviewing the applicant's most recent federal tax returns, and in doing so, you observe that they owed the IRS a considerable amount of money. Well, once you have knowledge of something, you cannot ignore that knowledge. If you do, you can get in trouble. So knowing that the amount that they owe the IRS does not correspond to the average daily balance of their assets, you have to ask them about that. And in answering, they share with you, yes, they had to go into a payment arrangement with the IRS. Well, now that you have knowledge of that payment arrangement, you must include the payment for that payment arrangement in with their back-end debt-to-income ratios in the form of long-term debt. So it's a sum total of housing plus consumer plus long-term debt, all on a monthly basis, divided by their gross monthly income, and that will give you the back-end debt-to-income ratio. You must also be knowledgeable about the 4 DTI guidelines: conventional mortgages, 28 housing, 36 back-end; FHA, 31 housing, 43 back-end; VA doesn't look at a housing expense, but it does look at a back-end debt-to-income ratio of 41%, and USDA, 29 housing, 41 total. These are just guidelines. If they're a little bit higher for the particular applicant, sometimes that could be overlooked with compensating factors. Follow and like for more helpful tips on mortgage origination and what you need to know to pass the NMLS exam.